Hi everyone, welcome to the second episode of Dollar X Dollar Finance. In our first episode, The Beginner's Guide to 2026, The 7 Principles. Every new investor must know we laid the foundation for smart, long-term investing. Today, we're taking the next step and breaking down something that overwhelms almost every beginner. You open your investing app feeling confident and instantly get slammed with a wall of jargon, mutual funds, index funds, ETFs, and suddenly that boss feeling disappears. It's confusing, it's intimidating, and the fear of making a huge mistake becomes very real. You start thinking, what's the actual difference? Which one should I choose? And that's a valid question, because picking the wrong type of fund isn't a small beginner mistake. It can quietly cost you tens or even hundreds of thousands of dollars over your lifetime through hidden fees and unexpected taxes. Today, we'll clear all of that up, simply and confidently. I'm not just going to give you dry, boring definitions. I'm putting these three heavyweights, mutual funds, index funds, and ETFs, into a head-to-head showdown, a battle royale for your investment dollars. By the time we're done, you'll know exactly what each one is, the key differences nobody talks about, and most importantly, you'll walk away with a crystal-clear framework for picking the right one for your financial journey. My promise, you'll finish this episode with clarity, confidence, and the certainty that you are starting on the right foot. But before we begin, a quick disclaimer. Nothing in this podcast is financial advice. It's for educational purposes only. Please do your own research or speak with a licensed advisor before making investment decisions. Let's start with the foundation. What is a fund? Anyway, before we get to the main event, let's pause and zoom in on the one simple word they all have in common: fund. Understanding this is the key that unlocks everything else. Imagine you walk into KFC or McDonald's. You could order everything individually: one piece of chicken, then a separate fries, a separate drink, then add a nugget, maybe a side, and so on. It would take forever. It would be inefficient. And honestly, nobody does that. Instead, most people just order a meal combo. The combo gives you everything you need in one go: chicken, fries, drink, maybe a side, all bundled together, no effort required. In the world of investing, a fund is simply that combo meal. But instead of chicken and fries, it's a basket filled with dozens, hundreds, or even thousands of different investments, like stocks and bonds. When you buy just one share of a fund, you're actually buying a tiny slice of that whole combination. This is diversification, and it's your best friend as an investor, because if one company in that basket goes bad, it barely matters. You've still got the other hundreds working for you. All three of our contenders today, mutual funds, index funds, and ETFs, are just different versions of these investment baskets. The real difference, the one that truly, deeply impacts your wallet, comes down to one single, powerful concept: active versus passive management. Think of it this way: an actively managed fund has a driver. This is a highly paid fund manager who is constantly, frantically trying to beat the market. They're changing lanes without signaling. They're looking for clever shortcuts. They're flooring the gas pedal, burning through expensive fuel, which is basically your fees, all in an attempt to outspeed everyone else and get to the destination a few minutes faster. A passively managed fund, on the other hand, is like putting a brand new Tesla into self-driving mode. It's been programmed with one simple goal: follow the flow of traffic and match the market. It's not trying to be a hero. It's just going to stay in its lane, obey the speed limit, and get you to your destination safely, predictably, and with maximum efficiency. And that one single distinction, the frantic effort to beat the market versus the calm strategy to simply be the market, is the source of pretty much every major difference in cost, performance, and taxes that we're about to cover. Now that you know what a fund is, let's kick things off with the oldest and most established player in the game, the mutual fund. Mutual funds are the original basket of investments. The concept actually traces all the way back to 18th century Dutch merchants, who were the first to create pooled investment vehicles so ordinary people could access diversified portfolios. But the first modern mutual fund, the one that set the template for everything we have today, was MFS Massachusetts Investors Trust, launched in 1924. This is what your parents, grandparents, and probably even your great-grandparents invested in. It's the bedrock of old-school investing. The defining feature of most traditional mutual funds is that they are actively managed. This means you're paying for a star fund manager, someone with a shiny degree, a corner office, and a full team of analysts behind them. These people spend their days crunching numbers, researching companies, and flying around the world to handpick the investments they believe will beat the market. They're the Formula One drivers of the investing world, racing to win the stock market Grand Prix for you. On paper, it sounds incredible. Who wouldn't want a team of financial geniuses managing their money? You get professional management and instant diversification, the whole investment basket in one swipe. However, this white glove premium service comes with three major catches that can quietly wreck a beginner's portfolio. First, the fees are high. And when I say high, I mean they can be devastating over the long term. Those expert managers, their teams, their research budgets, and their hefty bonuses don't work for free. All of that gets passed on to you through something called an expense ratio. A typical active mutual fund might charge anywhere from 0.5% to over 1% of your money every single year. Now, 1% sounds tiny, right? It's a psychological trick. If you have $10,000 invested, that's $100 per year. But when your account grows to $100,000, that's now $1,000. Vanished from your account every single year. Over 30 years of investing, that 1% fee can literally consume over a quarter of your potential returns. It's a financial termite, silently eating away at the foundation of your wealth. On top of that, some funds hit you with load fees, which are just sales commissions you pay to get in or out of the fund, sometimes costing you up to 5% of your investment right off the bat. Second, and this is the great irony of Wall Street, for all the money you're paying, the vast majority of active fund managers fail to actually beat the market over the long run. Year after year, study after study confirms that once you subtract their hefty fees, most active funds do worse than the simple, self-driving market they're trying so hard to beat. For example, the SPIVA U.S. Mid-Year 2025 report finds that 91.03% of actively managed U.S. large-cap equity funds underperformed the S&P 500 over the past 20 years. And in the 2024 after-tax scorecard, SPIVA reports that the median active fund after taxes trailed the S&P 500 across every time horizon by up to 4.4 percentage points annually. Third, and this is a sneaky trap that trips up so many beginners, they are horribly tax inefficient. Let's walk through this slowly. Imagine you, me, and 100 other people are all invested in the same mutual fund. One day, a bunch of those other investors decide to sell their shares. The fund manager is now forced to sell some of the fund's stocks to get them their cash. If those stocks have grown in value, this forced selling creates a taxable event called a capital gains distribution. And here's the truly insane part. That tax bill gets passed on to all the remaining investors in the fund, including you, even if you didn't sell a single share. You can literally get a surprise tax bill at the end of the year just for holding your investment, all because of what other people did. Finally, you can only buy or sell mutual funds once per day, after the market closes, at a price calculated at the end of the day called the net asset value, or NAV. You can place your order at 10 a.m., but it won't actually go through until after 4 p.m. at a price you won't know in advance. After everything we've just talked about with mutual funds, the high fees, the chronic underperformance, and the surprise tax bills, investors eventually reached a breaking point. People began asking a simple, obvious question. There has to be a better, cheaper, more reliable way to invest, right? And that frustration didn't just spark a debate, it sparked a revolution, the rise of the index fund. Before we get into index funds, there's one important clarification that will make everything much easier to understand. When we say index fund, we're talking about the investment strategy, a fund that passively tracks a market index. When we say mutual fund, we're talking about the structure, the container the fund lives in. So yes, you can absolutely have an index fund that is structured as a mutual fund. It uses the same low-cost passive approach, but it still trades only once per day at NAV, just like traditional mutual funds. And for simplicity, in this episode, whenever I say index fund, I'm referring to the strategy, not specifically index mutual funds. With that out of the way, let's talk about why index funds became such a big deal. For decades, investors were frustrated. High fees, constant underperformance, and surprise tax bills from active funds pushed people to ask the same question. Isn't there a better, cheaper, more reliable way to invest? That frustration kicked off a quiet revolution, the birth of the index fund. An index fund is the opposite of a flashy, high-effort strategy. Instead of trying to outsmart the market, it simply matches the performance of a chosen index. Take the S&P 500, the 500 largest and most established companies in the U.S. An index fund simply buys them all and holds them. No guesswork, no genius manager, no last-minute trades. It's a rules-based, computer-driven approach, the investing equivalent of a self-driving car, calmly keeping pace with the market. This idea became reality in the 1970s, thanks to one man, Jack Bogle, founder of Vanguard. Back then, Wall Street hated his proposal. Bogle argued that instead of gambling on high-fee managers who rarely beat the market, investors should just own the entire market at ultra-low cost. So in 1976, he launched the world's first public index mutual fund, the Vanguard 500 Index Fund. Wall Street mocked it as Bogle's folly. They said no one would ever choose a fund that didn't even try to beat the market. But Bogle was right, and the world eventually caught on. One of the biggest reasons index funds shine is cost. Without a high-priced manager and research team, fees are tiny. According to 2024 research from the investment company Institute, ICI, index equity fund expenses average about 0.05%, while actively managed mutual funds average around 0.64%, more than 10 times higher. That difference is massive. It means almost every dollar you invest stays in your account, compounding for you, not disappearing into someone else's bonus. And because index funds simply track the market, their performance is the market. You won't beat it, but more importantly, you won't fall way behind it either. Across history, simply capturing the market's return has been one of the most reliable paths to building real wealth. If you want proof, just look at Warren Buffett. Back in 2007, he made a famous $1 million bet. A simple, boring S&P 500 index fund would outperform a carefully selected group of high-fee hedge funds over 10 years. Wall Street's smart money took the bet and lost badly. By the end of 2016, the Vanguard 500 Index Fund Admiral Shares, VFIAX, had delivered an average annual return of 7.1%, while the hedge funds managed only 2.2%. If you started with $100,000, the index fund grew to about $185,000. The hedge funds, just $121,000. Buffett won in a landslide, proving publicly what the data had shown for decades. For most people, the smartest strategy is not trying to beat the market. It's simply owning the market at the lowest cost possible. So now you've seen why index funds were a revolution. Low cost, no drama, and the ability to capture the full power of the market without all the headaches. But the story doesn't end there. After index funds proved themselves, investors wanted something even more flexible, something you could trade like a stock, buy instantly, sell instantly, and start investing with just a few dollars. Wall Street listened, and that's when ETFs arrived. ETFs took the quiet revolution of index funds and supercharged it. The very first modern ETF launched in Canada in 1990, the Toronto Index Participation Fund, or TIPS. It gave investors a simple way to buy an entire index in a single trade. Just 3 years later, in 1993, the United States followed with SPY, the SPDRS and P500 ETF. SPY became a global phenomenon and is still one of the largest and most traded ETF in the world today. From those early beginnings, ETFs exploded in popularity and have grown into a nearly $19 trillion global industry. Think of an ETF as a modern hybrid, an evolution that combines the best parts of a mutual fund with the best parts of an individual stock. Like a mutual fund, it's a diversified basket of investments, and like an index fund, the vast majority of ETFs are passively managed, tracking an index like the S&P 500. But the key difference, the thing that defines ETFs, is right there in the name: exchange traded. ETFs trade on a stock exchange all day long, just like a share of Google or Microsoft. This gives them a level of flexibility that is a true game changer. You can buy or sell them at any moment the market is open, at prices that update in real time, second by second. This structure gives ETFs three huge advantages, especially for a modern investor. First, the costs are unbelievably low. Competition in the ETF world is brutal, and that's great news for investors. Take the legendary Vanguard 500 index fund Admiral shares. Its expense ratio is already impressively low at 0.04%, but its ETF counterpart, VOO, pushes costs even lower at just 0.03%. We're talking about some of the absolute cheapest, most efficient investment vehicles ever created. Second, ETFs offer true trading flexibility. Because they trade like stocks, you can watch the price move throughout the day and buy or sell whenever you want. For most long-term beginners, this is just a nice extra feature, but it does provide a level of control that mutual funds simply don't have. Take SPY, for example. Over the past 3 months, it has averaged more than 75 million shares traded per day. That kind of massive liquidity means you can get in or out instantly, anytime the New York Stock Exchange is open, with virtually no friction. Third, the barrier to entry is extremely low. Many traditional mutual funds require a minimum investment, often $1,000, $3,000, or even $10,000 just to get started. That can be a big hurdle for beginners. ETFs completely change the game here. Because ETFs trade like stocks, you can buy as little as one share, and with fractional share brokers like Robinhood, Fidelity, and Charles Schwab, you can literally start with as little as $1. This means anyone, students, young investors, or anyone on a tight budget, can start building wealth without needing thousands of dollars up front. ETFs democratized investing by making the threshold almost zero. Fourth, and this is their real superpower, is their incredible tax efficiency. Remember that infuriating tax problem with mutual funds where you could get a tax bill because other people sold their shares? ETFs pretty much solve that problem because you, the investor, sell your ETF share to another investor on the open market. The fund company itself doesn't have to sell its underlying stocks to cash you out. This is done through a unique patented creation and redemption process that allows ETFs to avoid spitting out those capital gains taxes to their shareholders. Over the long haul, especially in a regular brokerage account, this structural advantage can save you a serious amount of money. Is there any downside? The main one is that the very strength of ETFs, their flexibility, can also work against you. Because it's so easy to trade them, many people fall into the trap of trying to time the market, jumping in and out based on headlines, fear, or FOMO, and that almost always leads to worse results than simply buying and holding for the long term. Even Jack Bogle, the father of index investing, warned about this. In other words, ETFs are powerful tools, but only if you use them with discipline. All right, we've met the fighters. Now let's bring them to the center of the ring for the final tale of the tape. Management and philosophy. Traditional mutual funds are mostly active, with managers trying to outsmart the market. Index funds and most ETFs are passive, simply aiming to match the market. Costs and fees. Traditional mutual funds are, by far, the most expensive. Index mutual funds cut costs dramatically, and ETFs often take the crown as the cheapest option of all. Trading and flexibility. Mutual funds, whether active or index, trade once per day after the market closes. ETFs trade all day long, just like a regular stock, giving you real-time pricing and flexibility. Tax efficiency. Traditional mutual funds are generally the least tax efficient. Index mutual funds are better, but ETFs are the clear, undisputed champion here, helping you keep more of your returns away from the tax man. After everything we've covered, the verdict is clear. For most beginners, the best choice is a low-cost, broadly diversified index fund, whether you buy it as a mutual fund or as an ETF. The evidence is overwhelming. High-fee active mutual funds have a long, well-documented history of underperforming. Meanwhile, passive indexing, the approach Warren Buffett has championed for decades, has proven to be one of the most reliable paths to long-term wealth. So your real decision comes down to a simple personal preference. Choose an index mutual fund if you want pure simplicity and automatic investing. It's perfect for set-it-and-forget-it contributions straight from your paycheck. Choose an index ETF if you want maximum tax efficiency and the flexibility to trade whenever the market is open. The truth is, you can't go wrong with either. The real win is choosing passive, low-cost indexing and avoiding the high-fee, underperforming active funds that quietly drain your wealth. You now have the clarity, the framework, and the confidence to start investing the right way. If this guide helped you, make sure to subscribe for more simple, powerful financial lessons. Thanks for your time. Now go put your money to work and take control of your financial future.